The global economy is accelerating. China is just becoming more and more competitive. It's not just AI. They've found ways of, I think, increasing productivity. They're really at the cutting edge of a lot of the new technologies. I think compositionally, I think Chinese growth is sort of getting better and better. I don't say this because I'm in China, but China is our favorite markets.
I want to start with a broad question. What is UBS' latest forecast for the global economic growth in 2026?
Sure, it's a little bit above 3%, but one thing that is very confusing is, we, like the IMF, we express growth as a 12-month change. And those type of forecasts are really sensitive to the distribution of the quarterly changes. And so the Fed, for instance, looks at it on a Q4 basis. And so the reason I say that is because when you look at our forecast, it looks the same as last year's forecast. Like, there's no acceleration. When you do it on sort of the Fed's basis, there's actually acceleration. So it depends a little bit how you define it. So we think the global economy is accelerating. The tariff shock, I don't think is having the effect that people sort of thought, but we can talk about that. And then I think what's starting to happen is that the globally central banks have cut their policy rates in half, basically, since the peak. That's starting to have an impact on credit growth. We're seeing confidence recover, so not everywhere, but on average, confidence is recovering. The hard data is accelerating at the margin. So it really does look like we're in a better place right now than we were, say, 2 quarters ago.
As you mentioned, tariffs, do you think the risks of tariffs and trade tensions are being underestimated currently?
So one thing I'd say is that we haven't yet seen the full effect of the tariffs, right? And so you could look, for instance, at U.S. import demand. And so our estimate is that the effective tariff rate in the U.S. is about 11%. The statutory rate, so the rate that's on the book, is about 13%. And what you would expect to see in the U.S. import data is that demand goes down by about the amount of the tariff. That hasn't happened yet, and so there's a few reasons for that. So partly because the government keeps shifting the goalposts in the U.S., like I think there's been an incentive for importers to delay their adjustment. There's the Supreme Court case on the legality of the tariff, so maybe people want to wait to see if they get their money back, right? So there's all kinds of reasons why you haven't seen imports adjust that, but that also means that it may just be a delayed effect. So we do fully expect this year to see demand for foreign imports because of these tariffs to go down quite substantially. And so we thought that was going to happen in the second half of last year, but now it looks like it might still need to happen. So we're not quite out of the woods on the trade side. And then if you look at the inflation side, but that's sort of a specific US story, we think ultimately these tariffs are worth about 1.3 percentage points of extra inflation. As sort of a level change, and we've seen maybe a quarter of that. So I think there's, on both the inflation transmission and the trade side, there's still some to come. Now, the other, implicit assumption in our forecast is that there's sort of stability in the tariffs, but that was sort of a general assumption about what this year would look like, and it's been nothing but unstable, right? We have one announcement after the other of new sort of surprises, and we're definitely worried that this tariff tool sort of flares up again sometime in the course of 2026, and that could then again sort of be destabilizing. And then I mentioned the Supreme Court case. So our expectation is actually that these tariffs will be declared illegal. So that is 2/3 of the outstanding U.S. tariffs. Now, then the administration will, I think, reimpose tariffs under different legal authorities, but that is going to extend the uncertainty. So it'll be very messy to basically replicate what is in place. So these are all things that make us a little bit worried about sort of the improved confidence that we see, because we could have another sort of tariff shock or mini shock sometime in the near future.
Mm-hmm. And we know a large part of the tariff is about driving the manufacturer back to the U.S.
Yeah.
Do you think that it's ready? What's going to happen?
So it's separate. So one thing that's been important is, as part of these trade deals, they have these investment commitments, right? So if I just focus on the tariffs, I think it'll be completely ineffective, right? So in the following sense, so if you are a foreign producer and you are concerned about your market share and what the consumer ultimately needs to pay for your product, then you are much better off paying the tariff than moving your production. Right? So there's just really financially no incentive to move, leaving aside that you would have to make very significant capital expenditure, that you have the option of just waiting to see whether the next administration maybe rolls back the tariffs. And actually, there's calculations that suggest that if you really wanted to reduce the U.S. trade deficit and effectively sort of eliminate the goods trade imbalance, the tariffs are basically a quarter of what they need to be. So and they also, because productivity is so much higher, they won't bring back many jobs. But these investment commitments are very important. So I think, and they're political. So there are just certain sectors like pharmaceuticals, electric vehicles, semiconductors, where it is very clear that I think if you want to sell your product in the US, you will probably need to produce them in the US. But big picture, I don't think this is a strategy that's going to be very effective.
Mm-hmm. I also want to talk about the Fed because there's also a lot of uncertainties and markets are kind of divided on like what exactly the pace and the size of the Fed rate cuts this year. So what is your...
Yeah, so the thing that surprises me about the market pricing is that basically the market pricing is for about 2 cuts, so 2 times 25 basis point cuts. And that's sort of what we expect to happen. So the next one in July and then another one in October. But on one level, you could say, well, that's very conservative. So the Fed itself has 1 cut in their forecast. We in the market have 2 cuts. But if you think about where the White House wants these interest rates to go, it's much lower, right? And so why does the market not price sort of a lower landing zone? And so that's a little curious. Now, partly that's because there's inflation concern. There's also still lots of uncertainty about Fed independence. We don't really know who the Fed chair is going to be. So all these are things that are maybe preventing the market from pricing more rate cuts. But so if there is a risk to our forecast, I think it's a much greater cuts, not less cuts, right? So, but the baseline is 2 cuts for the Fed.
Mm-hmm. So do you think that will have like a large impact on U.S. or perhaps global economy?
If they only do 50 basis points, no. So now we they've basically, let's say they've cut interest rates by close to 200 basis points or so. That is showing up now in improved credit growth. Now it's not just in the U.S., it's showing up globally. So interest rates do matter, but that extra 50 basis points I don't think is game changing. On the other hand, you could look at the sort of the interest sensitive part of the U.S. economy is not doing well, right? So the housing market is still frozen. So every little bit will help a little bit, right? So I think there is a affordability problem in the U.S. I think there's distress at the bottom end of the income distribution. So people are struggling to make their credit card payments and car payments and their student loan payments, and so a lot of that debt is floating rates, right? So if you lower interest rates, you provide some relief, and then of course on mortgages as well, there's sort of a level problem on the mortgage rate. So it'll help a little bit, but I don't think if you sort of really look at what's happening in the U.S. economy, like it's not being held back by interest rates. I think it's uncertainty and other things.
So I want to turn to China's side. So what is your prospect or outlook for China's economy, and what will be the main drivers for its growth?
Yeah, so it's very early in the year, and we tend to revise our forecast quite a bit. And these new economy sectors we think are contributing about 1/4 of overall growth now. So they're basically now more important than the property sector, and that data is not well represented in the sort of in the overall data that we feed into our nowcasting estimates. And so when I look at our nowcast, it doesn't look so strong. But then we see, I think, what's really happening in the economy, and I think it's actually much stronger. And so you can try to find verification of those new economy sectors. And so one thing that I find very striking, and I think it's a reason a lot of people are becoming very optimistic or more optimistic about the Chinese equity market. China is the only country in the world that we look at where sales to employee ratios are consistently going up across sectors. That's an indication that China is just becoming more and more competitive. They found, it's not just AI, they found ways of I think, increasing productivity that we are not seeing in Europe or the US, and they're really at the cutting edge of a lot of the new technologies, and so for that.
So how about Eurozone?
So the Eurozone is very strange because when you look at the aggregate or average data, it looks like nothing is happening. It's very stable. But it doesn't make any sense because it's a very open economy. It's very exposed to the euro and the US and tariffs. And so really what should have been happening is that the trade part of Europe would have a big confidence decline and be slowing. And so the reason you don't see that in the average is that the Eurozone is sort of a two-speed economy. So on the one hand, you have the domestic bit that is exposed to the stimulus in Germany and defense spending doing very, very well. And then you have the other bit, which is the trade-exposed bit, which is not doing so well. And so the data is an average of those two. Now, this year, we get a lot of fiscal support. Two-thirds of that fiscal support in Europe is Germany, so it's quite concentrated. That will add about 30 basis points extra to growth. The same thing will happen next year. And so I think you can comfortably say that European growth is going to be close to potential, which is, it's not like Chinese numbers, but it's like, 1.2, 1.3, that type of number, right? So that's good for Europe. And so I think it actually looks quite robust.
So I also want to turn to the financial market. We know that the AI and all the technology is already and will be the crucial key driver for the probably equity markets. So what impact will it have on the equity markets like US and China? And
So one striking statistic for me is that if you look at the investment that was made in the US last year by the technology companies, basically the only investment being made in the US is technology companies, right? And so it's now over half of overall tech investment, and then within that it's really like 3 companies. But so everyone's impressed by that investment because it was big and it was driving growth. The equity market went up 50 times faster than the investment went up, okay? So the equity market is pretty pricing the optimism of what this investment is going to do very quickly, right? So that has obviously people concerned, and we may be years away from really seeing the diffusion of the technologies of companies figuring out how to change their workflow processes and becoming more productive. And so there are real questions over how are these companies going to monetize this. And so I think 2026 will be about, not just about sort of investing in the producers of the technology, which was really what sort of happened last year, but really sort of starting to look at, okay, who's going to benefit from the technology? So, and it will be looking at non-tech companies and trying to find, so we're very focused on companies that are very data intensive, labor intensive, are cheap and have low margins and could really benefit from this new technology, right? And so I think investors are nervous about the concentration of their investment in these companies. They don't know which company is going to win, and everyone's sort of trying to figure out, well, where are the next winners going to be? So I think that'll be a lot of folks in 26. I think then the other thing is there will just be a heightened sensitivity to any sign that there's going to be more competition in AI, right? So we had a DeepSeek moment last year. The profit margins of these US tech companies are so high, they look unsustainably high. So if you get competition, the market could respond pretty adversely to that. And so, we'll be trading AI news all year long, but I think it's too early to really know with any kind of conviction what AI is actually going to achieve and whether it will really be as effective or productive as the tech companies claim it's going to be.
So would you worry the markets are too reliant on the AI narrative?
So they're definitely overly reliant in the sense that the breadth of the market is very narrow, right? So in the US, if you look across what we call the Russell 3000, so that is all companies in the US combined, and 75% of all the returns last year were just in tech companies. So that is very narrow. On the other hand, and I mentioned it went up very fast, on the other hand, you look at the valuations of these companies, they are not what I would describe as bubble territory. So we look at things like price-earnings ratios for tech broadly defined, they're running at 27.5. For the Mag 6, they're running at about 33. In a bubble, you'd be running 50 to 70, right? So it really, and if you look at tech companies relative to all the other companies, they're sort of a little bit above a long-run average, but they're not yet super expensive. Now, having said that, when you have a new technology, it's a bit like the 1990s with the dot-com bubble. There's inevitably going to be lots of misallocation of capital. Okay, there will be mini bubbles that pop everywhere because we don't yet know who will be the winners and who will be the losers, but that doesn't mean that the technology will not be effective. It's sort of like the 1990s when we laid fiber optic cables and everyone got a computer and access to the internet, and there were lots of companies that went bust, but actually in the end the economy benefited, productivity went up, and we had lots of new companies that became the winners effectively. And so that's, I think, the phase we're in. We don't know who those winners will be. Doesn't matter to some extent. The technology, I think, will be transformational, I think, for the economy.
Mm-hmm. And also we have the safe haven asset. So will the gold still continue to grow?
So gold, yes, but so one thing that was striking last year is that traditional safe havens did not work, right? Mm-hmm. So the dollar, the treasury market, the two most liquid safe havens did not work because the US was at the center of the disruption, and so investors were looking for other safe havens, so they looked at things that still work, where German bunds and to some extent the Swiss franc and the Japanese yen, but actually also not as much as in the past. So gold was the big one, right? And now, interestingly, in our models, traditional models, we couldn't explain the gold price, right? So the traditional drivers are things like the real interest rates and the dollar and other things, but we have other models where we basically sort of attributed, we could do it for any asset, but we also did it for gold. How much of the gold price movement could you attribute to these shocks that we have? And what you find is you can explain something like 70% of the gold price move by just looking at all the policy disruption in the US, and particularly the threat to Fed independence. And we've seen that already now, right, the year to date, is that the threat to Fed independence is really a big driver for people wanting to flee into gold, because it's equated with a debasement of the dollar and sort of the stability in the US.
Mm-hmm. So from the broader perspective, what asset class do you see have relative advantages?
So it's really equity, and the reason I say that is, credit spreads are very tight in a trend-like economy. It's hard for them to get tighter. If you look at currencies, it's difficult for currencies to move a lot when no one's moving their interest rates, and so basically there's relatively limited interest rate movement across global central banks this year, so that keeps currencies relatively stable. Fixed income markets are basically pricing what the central banks are doing, which is not much. So really the movement is going to be, I think, in equity, where you could just have a bit of a melt up. That if you have there's a lot of liquidity still slushing around. If you have a trend-like economy and there are no major shocks and none of the other asset classes look attractive, the money will go into equity. And so we think the U.S. equity market will go up 10% conservatively, Europe 8%, EM, something like that as well. So I think equity is probably the place to be. The thing that will be really important for emerging market investors is what does the dollar do, and I do think we're very close here. Again, with the caveat that that this administration needs to stop doing new things that are destabilizing, but. Really, we're very close to a sort of the peak in dollar weakness here. So I think as the U.S. starts to accelerate, that's our forecast, and the Fed sort of comes to the end of its cutting cycle, and then hoping that the Supreme Court doesn't undermine the Fed independence, then I think we're going to start to see sort of the dollar reverse and start to strengthen. That would be a potential headwind for a lot of our emerging market recommendations. Mm-hmm.
So which emerging markets do you think will have a better chance to perform better?
So I don't say this because I'm in China, but China is our favorite market. So Brazil and China. So on the equity side, we think those are the two markets that offer the greatest value in terms of their valuations, their earnings growth. I think you have actually quite a lot of AI exposure by being exposed to China. So for instance, in contrast to India, like one thing we do is we compare China and India. We think they're actually very similar earnings forecasts. But I don't think you have AI exposure in India, you do in China, and India is much more expensive, so it becomes sort of an easy proposition. Also, I think if you're exposed to China, you are actually exposed to the things that people like, consumption and internet stocks and platform companies and things like that.
To wrap it up, my last question is, if you have one suggestion for global investor, what will be the biggest risks or opportunities they have to watch out?
Okay, so the biggest risks are, I think, the U.S. Trying to push through more fiscal stimulus as they go into the midterm election. So it's already, the U.S. is running a 6% of GDP deficits. If they do some of the things that President Trump has proposed, like stimulus checks, we'd have much higher deficits. And I don't think the bond market would take that well. That would be globally destabilizing. I think we could really see much higher bond yields, which would then affect equity markets. So that's a big risk. Then the other big risk, I think, is just sustaining this general level of uncertainty. I think the U.S. is sort of very close to slipping into a labor market contraction, right? So you have 90% of U.S. growth is now just AI investment and spending by the top incomes. That has almost never happened before. It's very unhealthy. So the labor market is, excluding healthcare, already contracting. Now, we think it gets better because there's no more policy shocks. But if this continues, this level of uncertainty, then you could suddenly slip into a recession. And so I think you really want to be monitoring very closely this level of pessimism. That this is the strange thing in the U.S. There's very strong headline data, incredible levels of pessimism. I mean, the top income households are the most pessimistic they have ever been about their employment prospects. That's partly AI and partly uncertainty. But so I think a lot of the risk to worry about are US-related risk, right? And then there's the geopolitical stuff, which I think is much harder for the market to sort. We always worry about that, but it's less obvious what the financial market implications of it are, other than maybe oil prices, going up or down. But so those are probably the sort of the obvious ones.
Mm-hmm. That's all the questions I have today, and thank you for your insight.
Thank you.
Thank you.